One of the most valuable lessons I've learned over the past decade in real estate is how essential it is to learn from the industry professionals. That's why I'm gathering professionals from across the country to share their experiences with you. This is a Gregerson's podcast, where experience and passion come together in the world of real estate. I'm Casey Gregerson, your host, and I'm very excited you're tuning into today's episode. As always, if you have questions for me or any of our guests, please reach out to me at casey@gregersonproperties.com. Now let's get started with today's podcast.
All right, welcome in. We're really excited for our guest today, James Bauer. So I know James really well. Got a little introduction for him, and I'm going to let him go into kind of his background as well. But yeah, anyway, James, so he works at Coldwell Banker. He's an agent and actually the co-owner there at the property exchange there in Cheyenne, Wyoming. So James has experience in residential, multifamily, commercial, and like even working downtown, spanning multiple states since 2001. So like James has been in the game for quite a while, over, 21 years. James is going to give us a ton of perspective from like working in like syndications. I know James has been part of syndications, I know on the GP side, I'm pretty sure on the LP side as well. And also even doing private money lending. He does a ton of his own investment. He has his own investment portfolio, has many different partners. I would probably say what you're probably going to get out of this by the end of it is James has a great network and knows how to really make the right connections. And I would say you're more, I've talked to other people too and heard this about James. He's more of like a sniper, I'd say. When it comes to like evaluating a deal and looking at deals, he's very selective, which has honestly made him very successful, I think, to where a lot of people look at a lot of deals and I don't know. That's one thing I'm going to pick your brain on today too, James, is how to be selective and find the right deals. Because I know patience can be huge these days. So anyway, that's a little bit of James' background. James, you can add anything to that. And then I'd love to kind of just jump into your story a little bit. What got you to here today in 2023?
It's funny. I was telling a group of investors last week that I've been investing for half my life. I'm 42, so 21 years is half. So I've learned a lot of lessons along the way. A little bit of background that got me into it. My dad actually taught the real estate class in California at community college. And so I've always had a bit of exposure to real estate through him. And my original entree was sort of the house hack, buy a house with 4 bedrooms, rent 3 of them out. So that was my first investment at 21 and learned a lot of lessons from there, but it showed me the light. So that was the original start for me.
Wow. What year was that you did your first house hack?
That was 2001.
2001.
Yep.
Awesome. No, that's cool. Well, cool. We'll keep going. So I know you got a background too in when you were working out in California before you kind of moved into real estate, and because you were managing some funds or go ahead.
Yeah. So I was an investment advisor by background. I worked in Newport Beach at sort of a boutique investment management firm. So that's the lens that I bring on the real estate side as well, just being able to evaluate cash flows and financial statements and really understanding an investment from the financial perspective. And not everybody goes through that. A lot of times you get emotional purchases or emotional buyers. So I would say that's one of my strengths, is removing that emotion and really just being disciplined about making a purchase. So yeah, I get to marry those two passions in my life, the original passion of investment management, and then today over the last 21 years with real estate. It's been a great combination.
Yeah, love it. So another cool thing is always to get people's background and like how and even whether it's real estate or whatever they gotten into, like what did they go to school for and how did that kind of, whether they use it today. Like I'm probably an example where I don't really use a whole lot of what I learned in college, but other people though that have came into real estate had degrees that really propelled them. But yeah, I'm curious your kind of college background, how you use that today.
It's funny, they say 90% of people don't utilize whatever they went to college for. I guess I'm the exception. I was a finance guy. And I was actually in kind of a pilot program that allowed me to get my certified financial planning certification at the same time. So that was a great background. So I used the finance component every day. After that, I went on to get my MBA, which really was just a rounding out for myself, kind of a polishing of education. I never intended to go back to the normal workforce and be an employee. So it was really just the knowledge that I was hoping for at the time. And kind of filling in between undergrad and MBA, probably 500 or 600 books related to investing, flipping, all sorts of development. Everything that I could find, I tried to devour. And I would say that those were probably as valuable as the formal education.
That's interesting, because that's, how a lot of people have gotten it is through book. Yeah, go into that more, actually, kind of the balance between, what you learned through your MBA and through undergrad and then through these books and how you kind of merged them all.
I think, the idea of formal education is maybe the process of learning how to think, discern, and, make decisions, how to synthesize information. But really, from the tactical standpoint, you get the strategic, maybe informal education, but I feel like the tactical can often come from books or podcasts or online sources, even things like this. And that's been really useful for me because one of the things I struggled with was implementation. The bigger ideas and theories that you might learn about in school or even in some books, and figuring out how do I take the first step forward and make it a practical application. So for me, those books were a fantastic bridge from one side to the other. And it's just amazing what people are willing to give you for a $12 book in terms of background information. I always say there's typically one nugget that if you just snatch one thing from a book, it'll probably be life-changing. So, I kind of joke about it's basically an overnight success, 21 years in the making or 23 years in the making of having read and dissolved taking in all that information.
Really? Yeah. Just keeping compounding it book after book after book. Man. Yeah. That's, yeah. And so to kind of paraphrase that, like the implementation sounds like you could get that from the books, right? Because the books would give you something. Hey, this is not only here's the concept of it, but here's how people, and really probably good books where people showed how they implemented it. And that kind of helped you propel you.
Absolutely. And I think, in some ways, when you hear somebody's personal story, it helps you break down the barrier of, well, how do I get this accomplished? Because you see that somebody else has done it. Sometimes they give you a blueprint, and sometimes it's really just giving you some perspective to say, well, this person's no smarter or more better prepared than I am. They just jumped in and made it happen. And so it's kind of like, an accountability buddy that you might get, not having it directly, but indirectly from a book to say, well, this person's done it. I'm going to jump in and do the same thing.
Yeah, love it. I could totally relate to that because a lot of times it's like, I don't know. As you read a book, you're like, if this guy can do it, he just laid it out for me. I just got to go execute it now. So yeah, to walk me through too, how you kind of made that transfer from more being on the like investment banking side and like you said, the boutique kind of fun type in that space to kind of moving into more commercial real estate and even becoming an agent, or was that all at the same time, or how did that transition go?
Yeah, it was a bit of an evolution. When I was doing my investment advisory piece, a lot of these high net worth people had significant holdings of all types. Stocks and bonds were certainly a component of it. Many of them were self-employed or just high earning professionals. But I noticed that among all of their holdings, as you're doing planning for them, many of them made a substantial portion of their wealth through real estate. And so that was kind of interesting to me, to see those case studies. Some of them owned real estate that their business operated within and leased out some of that space if they didn't use it all. A number of them had owned and purchased single family or multifamily properties, some near them, some from a distance. And what started to happen was, as I developed those relationships and rapport with them, they would bring me a deal. And they would say, this is a deal that I'm looking at in another state, or that my real estate agent has brought me, or maybe they would be looking at it from a limited partner standpoint, and they'd want me to just shoot holes in the deal. And what I realized is the majority of these deals were terrible, and they were happening, as the last real estate cycle was up and coming, and things were getting feverish. And, you sometimes struggle to tell people that the deal that's in front of them, that their friend or brother-in-law or whoever brought, probably isn't a great deal. And I realized that I really loved the aspect of analyzing those and looking at ways to improve the cash flow or maybe change the strategy into a property. And I thought there's got to be ways for me to marry those two interests. And so I'd already been kind of a small investor on my own, and I decided there's probably a way for me to add some value for myself and continue to grow my portfolio by increasing my knowledge. And then ultimately, I just decided I'm going to jump off and help other people on the real estate side, both in commercial and in residential, mostly investment. And so I was able to take my background from investment advisory, take my interest in real estate and my experience kind of looking at those deals and bring it to fruition back in 2017 when I got licensed.
Really? Okay. Cool, man. A lot to unpack there. So you mentioned too the last cycle. So you were actually poking holes in syndications or real estate funds or different types of deals. So before pre-2008, is when you were...
Yeah, so I was looking probably 2006 and 7 was when a lot of those deals were coming in, hot and heavy. And that was an interesting time because you just had deals that had no cash flow in markets that should have cash flowed, in Rust Belt type of markets where people were seeking opportunity. But yeah, it was interesting for me then, having had just marginal real estate investment background myself, but I understood numbers and I understood opportunity cost. If these people were tying up their money and having a degree of risk and not getting a commensurate return, it just didn't make sense.
Yeah. Oh, that's fascinating. Any other takeaways you saw back in before that big correction in 2008 that you saw that you maybe even apply today? You talked about a couple of them, just not really having deals that wouldn't cash flow, but I'm curious even what they were, what They were just betting on appreciation, basically, or
Yeah, largely they were betting on appreciation. And that's the thing is at the end of a cycle, you often get people who don't really understand what the fundamental drivers are. And so they end up purchasing things with the expectation that the last 5 to 7 years are going to be an indicator of the next 5 to 7 years. And that isn't always the case. A lot of markets have big swings, both up and down. So it's really understanding a cycle, when to be aggressive, when to be conservative. And I think identifying where you are in the cycle really should, in many ways, impact your investment plan.
Yeah, absolutely. Well, that's one of the big things we're going to work on or jump into today and really get kind of from your background then to what we're seeing in the market now and kind of your strategy. But I guess before we get in there, so yeah, you just said, hey, became an agent, started helping people in commercial and in residential. You said 2017, right? That was and when did you actually move to Cheyenne, Wyoming?
So I've been in Cheyenne since 2009. I spent about a year and a half in Fort Collins, Colorado before that, and then originally from Orange County, California. So I think I moved to Fort Collins in 2007.
Gotcha. Okay. So you started helping. And then, what did it look like kind of from, say, 2017 to kind of today, how you've kind of developed to becoming a super productive agent and also building your own portfolios and becoming and raising money and capital on bigger deals?
Yeah, so a little bit of background there. In 2017, I had two businesses that struggled and put me in a really tough place financially. And so that was really the impetus to jump off and become an agent full time. But what that did is it kind of hamstrung me for a while. I couldn't do much in 2017 because I was moving into a new industry. So I didn't have the experience of that income behind me to get traditional financing, and not having a significant nest egg to go invest. I was sitting on the sidelines for a lot of 17. I think I bought one thing. But what became clear was, as I got more involved in the community and the investment kind of network within the area, I was able to find deals. And, we call this being on the tip of the spear, catching deals when they first come in, either through your network of just other investors or other people who can be conduits to a deal, attorneys and bankers and, all sorts of people. And being an agent certainly helps if you're looking for smaller deals, smaller multifamily or single family. Being an agent is helpful. You can see it on the MLS. You're building relationships with other agents. So I just found myself in the catbird seat of all those things having come together at once. That presented a ton of opportunity. So in 2018, I started buying with both hands a lot of smaller multifamily fourplexes, triplexes, and duplexes. And then from there, I started learning a little bit about syndication in late 2019. And that was really kind of what opened my eyes into a different path of investing.
Yeah. Talk more about that too, because you'd obviously you'd been on the other side of it in your previous roles and seeing how other people were raising money in it. And now you went to go obviously start to raise some of your own money, knowing how to underwrite deals, how to poke holes in it before you probably presented it to your LPs. But yeah, just curious how that evolved.
So I was very fortunate in my office here at my brokerage. I shared a wall with somebody who'd already been doing basically partnerships. They've been doing smaller partnerships with 2 to 10 people for probably 5 or 6 years prior to me getting introduced to him. And he and I just kind of clicked. We had similar goals, similar interests, and we found ourselves attending the same conferences, like a lot of syndication related conferences as we were becoming more interested and wanting to grow our knowledge base. And so that kind of became a natural for us. We're in a similar location. We have similar interests and backgrounds, and now we're both wanting to get into that syndication realm. So having gone down that route, we decided this is a small town. There's no reason for us to compete. Let's team up. So I had the benefit of somebody who really had a mentor in this space for probably 6 years. So I wasn't starting from scratch. I was able to lean on some of the experience that they had, packaging deals, finding money, getting it financed, learning how to pitch it. And that has made all the difference, honestly. Learning it all yourself is certainly possible, but it's definitely a slower road.
Makes a ton of sense. Yeah. Love it. Maybe we'll dive into more like syndications and funds and kind of structure possibly later. But yeah, we started to touch on just the cycle of the market. So curious your kind of outlook on what you're seeing now and how kind of the moves you're making. Again, knowing you've seen the bigger corrections. You were in the game prior to 2008, saw the cycle, and just curious. I'll let you go on that. We can go a ton of ways, but what's your plan?
Yeah, well, I guess there are two answers to that. It's kind of the larger overarching cycle that's going on in the national economy, and then maybe how my local market may differ somewhat. I would say on a national basis, we're going to see a retraction. 2023 is probably not a year to swing for the fences, is what I've been telling people. Be selective about your deals, be underwriting in a very conservative way, whatever you're packaging. If you're a small flipper or you're just a buy and hold or you're packaging things for syndication, definitely being more conservative in all your numbers. I think that we'll see softness probably into mid 2024. Likely because it's an election year, we're going to see a little bit of dovishness or softness, and probably see those rates soften. But it'll probably begin to move the market, I would say, in mid 2024. In advance of that, over the next few months, I think we'll continue to see some softness. There will be opportunities out there, but I think people should be laser focused on what they're wanting to get into in terms of asset classes, if they're cash flowing or appreciation plays, and just kind of making sure that those are out there in the world so you know exactly what the opportunity is when you come across it.
Perfect. Yeah, no, that's a good summary to, being conservative, understanding whatever you're doing. Yeah, just really underwriting your deals. So yeah, and then go ahead. I'd love to go into kind of specifically Cheyenne, what you're seeing. Cause there's some markets where, you might not necessarily see, it might not be a big correction.
Yeah, I would say depending on segment of price, we're seeing probably 3 to 8% reduction from values from the top. What's starting to move now, I think we had a really rough 90 days. November, December, and January, the market was almost dead. And it's a combination of the cycle softening coming off of the top, and also the normal seasonality that you get around the holidays and the winter here. People don't typically want to move when it's terribly cold. But with that being said, over the last 2 weeks, we've seen a significant change of action, partially related to a little bit of rate decrease. But I think at the end of the day, the demographic drivers haven't changed, where you have the millennials that are the largest demographic in the country, larger than the baby boomers. They're still going through the process of housing formations, graduating college or getting together, getting married, which drives people wanting to have their own place, either purchase it or rent it. And so, those demographics that have not changed, the demand is not changed. If anything, it's probably going to have some more pent up demand as people who were considering purchasing a year ago maybe have held off for the last 7 to 9 months. Those people still want to purchase something, or they still want to make a move, but it might have delayed them a little bit. So we're starting to see that thawing. That's what I'm reading nationwide, and that's what I'm seeing locally, that things are starting to move. The projects that we did that were smaller projects, we had after repair values, and really we've only probably trimmed our sale prices down 3 to 5% from what we expected those to be. So not significant softness, something we fortunately built into most of our models. But certainly it's still a buyer's market at this point.
Interesting. So I wanted to dive into that because you talk to some people in places like Boise or Phoenix or some of these markets where it was like a 20, 30% correction off of the high, right? But again, you're saying like 3 to 5% is typically what you've seen.
Yeah, I would say around the median price point, 3 to 5. You might see something a little closer to 8 on the higher end. And during the last bust in Cheyenne, that's about what we saw was the highest, highest segment of the market got hit the hardest. Just because a lot of those people, if you're not a cash buyer, you're levering pretty hard. You might be a teacher and a firefighter making $250 a year, stretching for an $800,000 home. Those people have gone away now because cheap money is gone and the cost of servicing that loan just isn't feasible for them. So that really has slowed down that market, which also includes new construction, because mostly what they have to deliver are at the higher price point based on the costs.
Cost of building. Yeah. Interesting. And I was going to ask you about that too, like how the market in Cheyenne, and you can just kind of use this in general for Wyoming. I know you're Cheyenne as well, or the best, but so historically in those years, it was more of a flat line. As you said, it was the top of the market got hit a little bit, but it wasn't a big correction. So I'd love for you to talk more about like kind of the drivers, what causes that? Because I think a lot of people that invest maybe in other states, they do see these big swings and they also see big appreciation swings, but talk more about just kind of the steadiness or the constant appreciation you've seen in Cheyenne.
Yeah, so having been here since really around this area since 2004, but an investor here since 2009, the segment of this market it's fairly steady because there are a lot of what I call guaranteed employers. You see the federal government, city, state, county. A lot of times there's throughout Wyoming, whether it's larger towns or even mid-sized towns, there are schools, community colleges or otherwise. Sometimes there are technical schools. A lot of times those are drivers for employment. that don't have significant swings based on the booms and busts of the economy. So Cheyenne specifically during the last bust, peak to trough, roughly 2008 to 2009 or 10, wherever you want to call the bottom, the median sales price point was down 3 to 5%. So it wasn't a significant swing. And so, when I talk to people about this market specifically, we're sort of at the top of the Front Range region. We're getting a lot of overflow from people who want to leave Colorado as its dynamics change, both economic, social, cultural, etc. But we have that steady employment here that just doesn't cause this area to bust. But it also doesn't boom in the same way. We don't see growth of 20% year over year. I would say since I've been involved in this market, the largest year we've seen was probably about a 12% move.
Wow. Yeah. To me, it's fascinating, and try to explain that to people, the dynamics of Wyoming, to where you've got consistent, may not be huge appreciation, but it's consistent appreciation. And you don't have to see the big swings to where, because that's where you can get caught. And if you're flipping, or if you're maybe syndicating or doing a big multifamily deal, you could get caught in a big downturn, and that might be a couple years or whatever. But from what I've seen and what you're saying is, like, typically it's going to be pretty steady and up. You might have some flat periods, but even even like worst case, and like say you're underwriting a deal, and I know you do this, James, like kind of your worst case scenarios. What are like your worst case scenarios in specifically Cheyenne over the next 12 to 24 months look like?
Well, and I think it's largely, if Cheyenne gets sucked down, it's because the rest of the economy is really tanked, and nationwide we're in a world of hurt. And there's been a lot of postulation about what that looks like. 20 to 30% retractions in some of these markets like San Francisco and some of those in the Sun Belt that have been extremely heated. I would say from this point, I would be surprised for Cheyenne to retract another 5%, largely because all of the damage that is going to be done by rates has been done. They probably don't move up from here. We've probably reached some sort of a midterm equilibrium, if not likely seeing improvement. What you might see, though, is sort of a hangover of people who haven't made moves over the last few months, who might in some ways get motivated to sell from life circumstance, change of job, aging, whatever it happens to be. So I think we're still likely to see some more things come on the market, and we just kind of hope we have enough demand to take all of that and absorb all of that new inventory. I think that we will. But if you look at what's coming with the drivers for the Wyoming economy in general, a lot of employers moving here because of the political and economic landscape. There's so much growth on the horizon that I think we will get pulled out of any potential protracted recession before most of the other areas in the country will. And so from that standpoint, it's probably a very conservative play to be in this market, probably more so than many others. And as people call me and they're looking to make investments throughout the country, they're seeing this as a market that is stable. And I don't want to say it's immune to cycles, but it's less impacted by the cycles that are naturally in the real estate world.
Yeah. And you backed it up with, like, again, history shows us this. And just the microeconomics and macroeconomics of just what's happening in jobs and all that, it logically makes sense of why this isn't just just James's gut feel. There's a lot of data, and a lot of people are seeing the same things. It's good stuff. Where do you think the real opportunities are? And we've kind of talked a little bit about it, but where are you seeing the big opportunities in the next 12 to 24 months? Because I know we've talked about it. You're definitely gearing up to be ready for those. Where do you see those potentially coming?
They're all over. And, I hate to hit one segment because people who might be listening to this or watching this might be playing in different arenas. But even if you're a small investor and you're looking to try to get into the game, I see a great opportunity there to purchase something with significant concessions from sellers on price and closing costs. And there are a lot of, I would be hunting rate assumptions right now. If you're a small investor looking for smaller deals, try to find something where you can assume the rate. And I'm in the middle of those right now, a handful of those right now. You can pick up something at 3.25 when the market's, double that or more probably for an investor. So I would say that's short-term opportunity where you can scoop something up with some price softness and maybe get a good rate if you can find an assumption. If not, find a good deal with the thought process that probably sometime in the next 24 months you can refinance it at a lower rate. I think there will be some real opportunity in scooping up some larger multifamily and some commercial properties that have been purchased with cheap money that may have loan resets coming over the next probably 18 to 24 months. When you're buying something at 3.75% and now your interest rate is 8.5%, there are a lot of deals that shouldn't have been done that really were marginal that become terrible deals that people are going to have to get bailed out of. And so finding those deals either through directly through owners, or even having conversations with lenders who might take some of those deals back to scoop them up for pennies on the dollar. That's where I see opportunity over the next 2 years.
Yeah, that's good. Love that part. And backing up a little bit, when it comes to assuming rates, so this is a really good, I didn't have this one today, but since you brought it up. So investors typically, there's a lot of value there, right? If you're looking to buy a deal, assuming someone's loan in any market, but especially in this market, there's a ton of value and a great way for people to get in that maybe don't have the cash. But you being an agent, typically the challenge, what I see as an investor or a buyer is even if it's a listed property, getting agents or someone to understand what you're trying to accomplish, because it is very unconventional. But yeah, what is your kind of thoughts on how you versus some agents that are maybe confused by that and or think it's, hey, this is not, some may argue that this is you're not even allowed to do that. But I'm curious how you approach that when it comes to like actually an on-market deal on the MLS.
So some agents have been savvy and they'll be marketing it as such, as an assumable loan, because they understand that it's a great tool to get a property sold to the benefit of the seller. If that isn't an option and somebody's really hunting and rate assumption is their primary goal, I would have their agent probably look at properties that are on the market, go back to the most recent sale that's recorded on the MLS and see how it sold. Oftentimes they have financing data and they'll show that it sold with a VA loan, which is largely assumable. So you might go hunting properties that are currently on the market that last sold with a VA loan, and you might go hunt and see and make offers with assumptions in mind, or call and talk to those agents. And so that would be a way that I would be trying to find those that might not be advertising themselves as rate assumptions, but would have that as a potentiality.
That is a great golden nugget James just gave you guys. Yeah, literally just go back through the records, check out VA loans, because as you mentioned, those ones are assumable. Other loans that are not assumable can be a lot more complicated to make that happen and or even impossible, but that's a really good nugget. Cool. Well, let's transition. I like talking for creative finance. I could go for a while there, but let's talk about more like raising funds and syndications and kind of like the value. I'd love for you to talk about more so you as the GP or somebody as a GP, but really talking to those LPs out there that want to put, even in this current market, right, where maybe they've got some cash, maybe they've been in the stock market and hasn't performed as well, or maybe they've sold something, or maybe they've just been keeping cash on the sideline and they've got an opportunity to get in now. Like, what would you kind of say to those people?
I often look at risk-adjusted returns, and there are all sorts of charts out there, historical data that shows how real estate has performed against every other asset class. For those people who you're largely raising money from, they're probably of an age that they've been through enough stock market cycles that they're sick to their stomach with the volatility in the market, which is dictated by so many things, sometimes even just the legislative stroke of a pen. And so, in our conversations with people, there are a number that have lost the confidence in the market, the stock market specifically, and they know they need to put the money to work in a productive manner. They're looking for some tax benefits, and syndication is a fantastic fit because they don't want to be dealing with tenants or trying to seek deals directly. They really are looking for mailbox money. And I would say the world is awash with people who are looking to put money to productive use. And it's really just showing them the value proposition that this is probably a lower risk opportunity than many of your other alternatives. It's pretty much passive once you make the commitment to invest. And it has some tax benefits that most of your other alternatives won't have. Once you navigate that process with people, it kind of sells itself.
How do you do it when it's a new investor who's new to this and it's been primarily had their money in the stock market and maybe you don't have it's not somebody you've known for a while, but they're interested in getting into it, right? Because if they understand you and they know James Bowers or they know myself and they know we've been in the game and they've been producing returns, but they maybe don't quite understand the low risk of that. How do you kind of walk those people through that? They might still look at you like, hey, well, again, this is a guy that I don't have a long relationship. I'm betting on his track record, but I'm just curious how you make those people comfortable with, hey, this is, as you mentioned, this is a less risky return than the stock market, but they might not look at it like that.
Well, you can break out all sorts of charts and data to support it. If you get to that point, then there's probably been a breakdown in the communication or relationship. Our process has been finding other investors to do the sale for us. Let me give you a good example. If you're at the country club golfing and someone that you know well, an associate or friend, has been investing in one of my funds over the last few years, they're going to make the sale for you and say, look, this thing has been successful. The returns have been consistent. They make sure that they're protecting the downside risk on the front end by doing all sorts of these things. I utilize the other investors, past investors and current investors in our deals, and allow them to kind of make the sale and make the introduction. because it can be often challenging to find somebody cold off the street and say, you don't know what syndication is, let me explain it to you and why it's the best option. I'm not a sales guy by nature. I kind of inform and let people decide, but you can utilize the other tools that you have, which are the other past investors or other people in their network who have a relationship with you, if you have the track record. Without that, it's a little more challenging.
Yeah, that's good feedback. What would you say to a limited partner that's looking to get into a syndication or a fund right now? What are some of the things that you think that you would look at right now? Again, you used to poke holes in that stuff. What are some kind of quick tips you could give them?
Well, you always ask the question about, what's the worst case scenario? And I think that's what I would be asking now as a limited partner. If they pay too much for it, if you can't sell it for what it's worth, if the operational costs are substantially more, if you hit on all three, do I lose all my money? Is this a terrible deal? So I would be looking at it through what is the worst case scenario, and have your general partners thought about that and communicated those potentialities to you, and kind of running multiple scenarios. We like to do this as we're kind of working the numbers on a deal. If we don't hit our target or our expectation, what is the potential return? Is that an acceptable potential outcome or is it not? So I would say being very conservative in vetting experienced people who are playing in the space that they have some experience in, a track record specifically in that segment, and really understanding what the downside risks are and if that's acceptable to you. Some people over the last few years are probably involved in syndications that maybe shouldn't be because they don't understand the risks, because they haven't been communicated properly. And that's one of the pieces that I'm always sensitive to.
Yeah. What are some of the questions too? Any tips you can, that you can ask to understand, hey, is this guy just a function of a market that's been going up for 5 years, or does he actually understand the fundamentals?
Well, and part of it is understanding. I always ask the difficult question, tell me about the worst deal you've ever done. How did it go wrong? Well, what have you learned and what would you do differently? And most people, if they don't have a deal that's gone wrong, they might be too new to be taking outside money, or I guess they could just be lucky, but likely haven't been in the game long enough. So I think my dad always says, I would rather go into battle with the grizzled veteran, somebody who's been through it. Doesn't mean that they have had to have been in this for a very long time, but certainly have had a lot of deals under their belt and seen a lot of things, because there's a very, very few things that can replace the direct experience of making mistakes and having successes.
Yeah, I love that. That's spot on. Just understanding what they've been through, like the hard times. And yeah, that just teaches so much. I think you just drove a great point home. I meant to ask you earlier, you were talking in 2017 that were just gotten out of some businesses that didn't go as well as you wanted. I was curious, were there any lessons I'm sure you've got lots of them, but lessons you learned from that you've applied today?
Absolutely. Well, one is I got into two businesses that I thought were going to be passive. So really understanding what passive means, and kind of defining your interest and potential involvement in an investment, whether it's a partnership or it's a business that you're buying. I chased things that I wasn't passionate about, had no background in, no interest in learning, and geographically were not near me. And so I probably hit the quadfecta there of things not to do. But it was a fantastic learning experience for me to understand not to go do things just for the money. If you're getting into maybe learning more about syndication, either as a general partner or a limited partner, if you become passionate about it and it's something that you really enjoy, you're going to take the extra effort to go the extra mile to learn everything you can. And that'll help you avoid a lot of mistakes, just having the passion behind the purpose for getting involved in something, whatever it happens to be. So I would say the lesson for me, many of which, but one is to just stay in an area that you're absolutely passionate about, because the education will be easy.
Yeah, love that. Man, that's good. I was curious too, you mentioned this earlier too, talking about people, when you're talking about, because you talk to LP, limited partners or investors or people that are looking to put money to work in real estate sounds like across the country. I'm curious what you've seen or what you advise people as far as diversifying in different markets, whether it's Wyoming or Texas, California, East Coast, Sun Belt. Like, what do you, I'm just curious your outlook on that. Do you try to be diversified? Do you try to have different markets with different appreciation, different cash flow?
I've just, over the last probably 18 months, gone down that path. And part of it is, I get too heavy personally in certain markets, and then you realize you have a degree of risk if a black swan type of event happens in that market. So I would say yes, certainly finding markets that maybe they don't necessarily have to run in counter cycles, but having some variety there will help give you some protection. But Oftentimes I tell people stay in your lane. So if you know and love self-storage, you can replicate that self-storage investment throughout the country. I have typically decided to spend my time in markets where I find I have a competitive advantage. So I'm looking at tertiary markets, markets with less than 150,000 people probably that might live in the shadow of a larger MSA, because I feel like we have some competitive advantage in finding those owners, those deals. We understand the dynamics that drive those markets. They're less competitive. There's not big money chasing those deals as often, and you can get some better returns. So understanding the markets that you can be successful in, the asset class that you can be successful in, and when you need to diversify. I think most people understand that naturally, that there's a need to do that, but usually not until you've really, amassed some pretty substantial assets.
Yes. I'm going to want to dive more into the tertiary markets, because me and you've talked about this, and I have a lot of conversations with like why. So I live in Houston, Texas, but do a lot of our investing in Wyoming and Montana in these tertiary markets for some of those things you mentioned of like, hey, there's not, because if you have conversations with people in Houston or Atlanta or some of these other markets, these bigger Sunbelt markets, there's all these hedge funds, all just a ton of money, a ton of buyers buying stuff, right? But it creates so much competition to where if you're trying to find those deals, you're competing against a bunch of people, but it's easier to sell them, right? But when it comes to these smaller tertiary markets, I just love to dive a little bit deeper into like, and maybe what are some of those, like the reasons why, because some people might make an argument that, hey, well, in these tertiary markets, they seem too risky. They seem like, hey, well, if we don't have all the hedge funds and all the money or institutional money there, then maybe that market is more riskier. But what would you kind of say to that, and how really defining that? Really, is there more risk in these tertiary ones?
Well, I would say the risks are things that you can quantify and deal with more easily into the model. You hit on one, which is if you have an asset in Houston versus having one in Laramie, Wyoming, your buyer pool is substantially different. But you need to bake that into the deal, meaning you need to have a very conservative sale value or back end value. And so those things, in many ways, I find like are easier to predict. Let me give you an example. If you have a market like Cheyenne that might take one step back and then takes incremental steps forward versus a market like Denver, which is one of the biggest swingers in the country, where it takes 5 steps forward and then 3 steps back, how do you predict your cash flows? And really, all of our investments on the syndication side, or even as an individual investor, are all about managing the time value of money. How you can expect the potential future cash flows, either from operations or from sales. And in big markets, it's much more difficult to predict because of the volatility. Whereas if you're in a market that doesn't have significant volatility, you're less concerned about your window to sell. You'll have a good time horizon to sell in 5 years or 15 years. Whereas if you're buying in Denver, it's typically 10 years up and 2 years down. You'll have to time your purchase and sale a lot more, I would say a lot more diligently. So from the standpoint of risk, if you're looking at risk as a function of volatility, which is how they often measure that in the stock market, that's why I like tertiary markets. Many of them don't boom and bust in the same way. So from the standpoint of compounding my money, compounding investors' money, it's much more easy to predict.
Yes, I was just about to say predictable. They're so much more predictable than some of these other ones. But yeah, I love how the one thing I want to highlight you said is basically you work it in when you go to sell, like it's your back end value of what you're going to sell the asset for. Yeah, you're going to be more conservative, and because maybe you're not going to have all the buyers or all the, as you mentioned, the buying pool, or you're not going to have institutional buyers or a big hedge fund buying a bunch of properties, but there are still going to be buyers, and just be a little more conservative on the buy side. Yeah, that's really how you de-risk it. But your cash flow should be much more consistent, and you can find different numbers. Yeah, that's a really good recap, James.
And something else to consider is if you're buying a deal that's going to run 10 years full cycle in either market, Denver or Laramie, your Denver deal may not have a huge payday until year 10. Your cash flow might be minuscule. You might be getting 3 to 5% cash on cash return. Whereas in a deal in Laramie, you might be getting 12 to 15% cash on cash return every year. And maybe you're not going to triple your investment at the end like you might in Denver. It might only be a double, but you're getting the time value of money. You're getting your money back sooner in the Laramie deal and in a more predictable fashion. So if you look at the internal rate of return, how the investment actually performed, you might have made more dollars in totality in Denver, but it took you that much longer to earn it. So those dollars didn't come back to you for reinvestment. So, and when you're banking on purely appreciation, there are so many potential things that can impact that are a long-term risk over a 10-year deal. Tax changes, financing changes, things that are difficult to see. And so if you're hoping for the golden payday at the end and that doesn't come in the Denver deal, you're in a world of hurt.
Yeah. That's really good, really strong point. Because yeah, again, you got time value of money in these tertiary markets. You're getting cash flow, and generally, if you're doing the right deal, and yeah, and then you got a predictable payday at the end. That's really good. The last thing to dive into there with these tertiary markets is you mentioned you guys kind of understand how to find them, how to negotiate them, how to look at the key drivers. I'd love to dive more into that because again, it's a different game than playing in a big MSA, but versus a tertiary market. How are you able to? And I know we do a lot of this as well, but I'm curious your perspective of how do you know each one of those little markets that may be a little bit niche or have specific, just little intricacies and maybe, especially like when you're not just in Cheyenne, right? Like I'm sure Cheyenne, you're going to know the ins and outs of that, but how do you know another tertiary market and get in there? Or you just apply the same things?
So it's interesting. The approach can be sometimes different. Let me give you an example. When most people are looking at Austin or Houston or Denver or, these larger metros, they're sitting on their computer and they're pulling up data from the past. It's always looking through a rearview mirror, right? And you're guessing on the projections, but largely you're taking that data in a vacuum, just pulling it from some source, but you're often removed from what's going on because it's such a large community. It's tough to know what's going on in there. Oftentimes in the smaller communities, you can go visit or pick up the phone and talk to the people that are running the Chamber of Commerce or the local economic development entities, or go into the communities and talk to those lenders, the people who are the pillars of the community. They'll tell you what's going on. They'll tell you about the drivers, and the dynamics of how you gain data in those markets are very different. And because there's not as readily available data to analyze a Laramie or a Cheyenne, the person who's willing to put in the time to be the boots on the ground has the competitive advantage. And so that's what I mean by being in markets where we can have an advantage. Somebody analyzing Cheyenne is not going to get on a plane and come have these conversations the same way that I'm willing to do. And part of it's the culture of kind of the Midwest or Rocky Mountain region, being willing to be belly to belly. But I always tell people, one of the greatest things that one of my mentors told me when I started is real estate is a contact sport. A lot of things happen belly to belly. You can try to do deals and analyze them from a distance and make offers on things you've never seen. That's fine. But the rubber really meets the road when you physically are there, seeing what's going on in the community and talking to people.
Love it. Real estate is a contact sport. That's a great takeaway. And love the relationship. So to summarize, it's versus data in a bigger market. In a tertiary markets, it's more relational and you're just knowing the right people. And
it's both. I mean, you utilize Site to Do Business and all the other places where you can find the data to aggregate it. And I think that supports your case, and you're utilizing that as your underwriting or you're sharing that as a pitch in a syndication. So you have that, but it's not of the same quality and depth as would be available in a larger city. So it's as much art as it is science, if that makes sense.
That's a great way to put it. Cool. Well, yeah. Any other, we got through a lot of stuff today. This is what I wanted to highlight. Any other things you'd kind of say with people that are looking to make moves over the next, as we've been talking, next 12 to 24 months, whether they're an agent, whether they're an investor, a limited investor, or limited partner? Anything else, thoughts you would leave them with, James?
I would just say be a student of the game. And if you're, whatever segment you're interested in, if it's syndication, there are podcasts, there are books, there are resources, find a mentor. If you're wanting to be a small buy and hold investor, find somebody in your market that's been successful that might be able to teach you the ropes of the game. This is a great opportunity to keep some powder dry, be very diligent about, disciplined about the deals that you execute, and learn as much as you can in this opportunity of kind of what could be a quiet year. But certainly present some opportunities. I think we'll see those toward the end of the year becoming more and more prevalent.
Awesome. Good. Well, good stuff, James. I really appreciate you taking the time. You give us a lot of good perspective on not only just a local Cheyenne market, but also national, and even looking at fundraising to being limited partners to finding your own deals and what to look for. This has been awesome. A lot of golden nuggets.
As you may have learned by tuning into this episode of Gregor Sense, the easiest way to make real estate investing hard is by going at it alone. So as you continue learning and seeking knowledge of the industry, I want to encourage you to build relationships with other professionals who are passionate about real estate. Whether that's an agent, a business owner, or a managing investor like myself, there are pros that want to see you succeed and are willing to help you by sharing their experience. You can always reach me by visiting CaseyGregerson.com and scheduling a call. I look forward to connecting with you and continuing to share my experience with you here on Gregor Sense Mobile. Until next time, I'm Casey Gregerson. Thanks for tuning in.